Last week witnessed a significant uptick in oil prices, with crude oil surging over 6%, marking a notable recovery from the previous week's downturn. The escalation of tensions in the Middle East largely fueled this increase. Israeli military actions in the Gaza Strip, particularly the bombing of Rafah, intensified market concerns, significantly contributing to the spike in oil prices. The rejection of a ceasefire with Hamas and the ongoing hostilities suggest that the market may have previously underestimated the impact of regional instability on oil prices. Adding complexity to the market, Russia's increased crude exports surpassed OPEC+ limits, attributed to drone attacks and technical issues at Russian refineries, casting doubt on Russia's adherence to production cuts. Additionally, U.S. sanctions against entities violating the price cap on Russian oil added another layer to the global supply landscape. Meanwhile, in the U.S., a return to peak production levels and significant refinery downtimes tightened the oil market, with output reaching 13.3 million barrels per day. Decreases in gasoline and middle distillate stocks highlighted constraints in refinery capacity. These trends, coupled with a diesel shortage in Europe, fostered a bullish sentiment in the oil market. In the upcoming week, the oil market is poised to sustain its volatile trajectory. Geopolitical tensions, notably stemming from the Middle East, coupled with Russia's erratic export patterns, are expected to drive prices upward. Strong demand from major oil consumers such as India and the United States remains a key factor bolstering bullish market sentiment. However, it's essential not to underestimate the influence of the US dollar on oil prices. Its robustness could potentially dampen global demand for dollar-denominated crude oil. Considering these dynamics, the short-term outlook for crude oil leans towards bullishness. It appears that the market is undervaluing the risks associated with ongoing geopolitical tensions and supply constraints. Traders should prepare for possible upward shifts in oil prices, particularly if the situation in the Middle East escalates further or if Russian export activities continue to confound expectations. Finding a delicate equilibrium between supply worries and global demand will be crucial in shaping the market's trajectory in the near future. Over the past week, the nat gas market saw some major shifts that resulted in prices plummeting to a three-year low. This dip was driven by a variety of factors, including ramped-up production and shifts in policy. The primary driver behind this shift was a sharp uptick in natural gas production, coinciding with decreased demand spurred by unusually mild winter conditions. These warmer temperatures substantially curtailed the need for heating, consequently reducing domestic nat gas consumption. Additionally, the slowdown in activity at LNG export facilities contributed to the surplus, resulting in an accumulation of supply. Moreover, the market responded to the Biden administration's recent halt on new natural gas projects, injecting a fresh layer of uncertainty, particularly concerning the future of LNG expansion and production growth. The ongoing political discourse surrounding this moratorium, especially in light of potential policy changes under different leadership scenarios, has further heightened market unpredictability. On the global front, despite facing internal challenges, the U.S. remains a significant LNG supplier. However, domestic LNG export capacity has experienced a downturn due to operational setbacks at key facilities. Weather and storage dynamics have also played a pivotal role, with sustained warmer weather patterns driving down natural gas demand. Current weather forecasts indicate that this trend is likely to persist, exerting continued pressure on gas prices. In summary, although the short-term forecast leans towards bearishness, factors like weather patterns and policy uncertainties continue to wield significant influence over the nat gas market. Traders and investors should remain vigilant as the market landscape is subject to rapid change, driven by a multitude of factors. Of particular interest will be how technical oversold indicators influence decisions, potentially prompting short covering, profit-taking, or even aggressive counter-trend buying. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.